Hello, investing friends, friends of financial freedom. Welcome into Investors Club. Got a great show for you. We've been talking a lot about how triple net leased REITs are the best sector of REITs, and we think the best stock in there is ADC Agree Realty. We have CEO Joey Agree with us. Let's get right to it. So excited, Joey. How are you?
I'm doing great. How are you?
I am great. Thanks so much for joining us. I know how valuable your time is, and we had some tech difficulties. So if it's okay, I'm going to launch right into it.
Fire.
All right. First of all, you're in Michigan, is that right?
I am in Royal Oak, Michigan, our new office. We just moved in about 3 weeks ago.
Yeah, you just moved in. I was hearing about it. It looks beautiful. Yeah, that's what a great view too, and a beautiful day you got. You got a gym. You got coffee
Woodward
bar.
Avenue behind me. That's Woodward Avenue, the first street in the United States with a traffic signal.
Is that right?
That's right. We'll have the Dream Cruise here in about 2 weeks with 1 million people with classic cars up and down Woodward Avenue.
Awesome. And you have the perfect spot for you. You have to stream it.
I'm in the middle of it, yeah.
Awesome. Thanks so much for making time. I'm going to launch right in. Can you tell us about the history of Agree Realty and your family's role, and you and your family's role in the company?
Sure. Yeah, my father was really a Kmart developer when Kmart was on top of the world of AA credit before the rise of Walmart. In 1994, Kmart was based in Troy, Michigan, about 5 miles from here. In 1994, he took the company public and put 16 of those Kmart anchored shopping center assets into the REIT. And from 1994 until 2010, I joined in the mid 2000s. I'm getting old, I can't remember. The company was solely focused on development. And so Borders was in Ann Arbor, the advent of the book superstore. So we owned their flagship stores across the country, developed over 40 Walgreens in 5 or 6 states. And then in 2010, I launched our acquisition platform. At the time, we were about a $250 million enterprise, 72 properties in 16 states, 75% of which of our EBR or NOI came from Borders, Walgreens, and Kmart. We know 2 of the 3 are no longer with us today.
Yeah.
And so when I launched the acquisition strategy in 2010, there was really 2 principles. One, we wanted to focus on what we called e-commerce resistant at the time. Obviously, Amazon was still really in its nascency. E-commerce was in its nascency. It was only 1.5% of total retail sales, but I could see the impact it had, frankly, from the Borders experience on brick and mortar sales. Right? The visibility, the transparency that it gave to consumers on price, the modality of it, the simplicity of it, rather than going to one side of the mall and then walking to the other side of the mall, or driving to one store or then driving to price check.
Yeah.
And then 2 is what we call really core brick and mortar goods, non-luxury, non-discretionary. So we call recession resistant. So you don't see us investing in anything. Frankly, I tell people, she hates when I say this, generally where my wife shops. We don't buy those. And so we're focused on core brick and mortar necessities here. And so we needed to diversify the portfolio. That was very clear. 72 properties in 16 states. And so we launched the acquisition platform in 2010. And the last 13 years has basically been history now.
So just so everybody knows, in 2010, you launched your acquisition strategy you had 72 properties at the time.
72 properties,
and now you
total employees. Yep, 75% of the annualized base rent came from Borders, Kmart, and Walgreens.
And so in 13 years later, with retail dying over that 13 years, you've more than 20x'd, you've like 30x'd. You have more than 2,000 properties now. Is that right?
We eclipsed the 2,000 property mark last quarter, and the portfolio continues to grow. We average at least a closing a day here, so you can assume it continues to surpass that. 400 acquisitions alone last year, approximately.
It's incredible growth against the backdrop of retail dying. Just really, really incredible. All the more incredible. Okay, and then I want to talk about the triple nets themselves. The next question goes to curb to curb. So don't talk about curb to curb yet. But can you talk about you focus exclusively on triple net leased properties. Can you tell us about the advantages of that strategy?
Well, again, the company started as a shopping center developer, right? That was its nascency pre-IPO in 1994 as Agree Development. I grew up on a shopping center site. And so my dad built most of the shopping centers. I literally grew up on a bulldozer. My dad was the general contractor for many of those shopping centers. And so I grew up in that business. I understand that business very well. The core essence of the shopping center business is the small tenant space, right? At the end of the day, the anchors either own or they pay very low lease rates in the inline small tenant space and the outlots, depending on how many there are, what really drives profitability in that space. And so you have significant turnover in the shopping center space and the small tenant space specifically, right? You have leasing, you have CapEx, you have commissions, you have downtime. And so that space is highly cyclical. You see most shopping center REITs range around the low 90s in terms of occupancy in the small shop space. What I recognized early on was that the best retailers in the country, and I won't get to the curb to curb, I'll try not to, but the best retailers in the country, if you looked across the board today, they're freestanding. So if you name the 10 best retailers, Joey, in the country today, right? Think about it, from the 200,000 square foot behemoths down to the small little formats. Let's start at the top. Costco, Home Depot, Lowe's, Walmart, Target. Can't forget any of those probably, right? The 10 best retailers in the country.
Yeah.
You get to the medium-sized guys, the best grocers in the country, Wegmans, Publix, Kroger, Market Basket, H-E-B, Aldi, Tractor Supply at the 20,000 square foot range, all the way down to Starbucks, Chick-fil-A, McDonald's.
Yep.
They're all freestanding.
Yes.
They're destinations unto themselves.
Gotcha.
Many of them own a significant piece of the real estate, but that was quickly recognized here. And so in a business like ours, it's low intensity in terms of turnover and vacancy and leasing and asset management. And that stability in the underlying retailers really drives what we call our sandbox today of the 30 plus or minus best retailers in the country. Now that all changes with your next question. Not changes, but gets added with the incremental layers with your curb to curb.
Okay, we can get into the next. The one thing I wanted to point out to people, because we talk about other types of REITs that have to do a lot of maintenance, and there's a bunch of advantages to not having to do maintenance, having this triple net where the tenant does the maintenance. Yep, and so just some other advantage. The long leases. You talked about your tenancy being so good. So there's a bunch of other. We're going to talk about your geographic diversification. You're able to do that again because you don't have to service these buildings. Yeah, and so there's a bunch of the triple net just gives you a bunch of advantage. Okay, great. And then you held off. I appreciate you held off on talking about the curb to curb. Not only are all of your properties triple net leased, but they're all freestanding that control their entire premises from curb to curb. You have a great white paper talking about how hard it is to get people in the door these days. They'll still come to your location, but they might not go in the door. Can you talk about the fact that you own the advantages of owning the whole location?
Yeah, thank you for referencing the white papers. I think they've been frankly underutilized, undermarketed by us. We typically send them to our distribution list, so I encourage anybody to sign up on our website. But if you go to our homepage, you scroll down, all of our white papers that we've published, I believe there's 8 now today, talk about different aspects of retail real estate, inclusive of curb to curb. We used to call things, when I launched the acquisition platform, e-commerce resistant. That was one of the principles. Very few things, if anything, except maybe getting your haircut, is e-commerce resistant today. And so what we call today is a brick and mortar omni-channel critical. The future of retail is omni-channel. It's buy online, deliver to your house, maybe one day by a drone or an autonomous vehicle. We'll see when that comes to fruition, but the tests are in place. Buy online, pick up in store. Buy online, pick up at a locker outside the store. We have stores, H-E-Bs and Best Buys that have exterior lockers. Walmart has their micro fulfillment facility open, so it's micro fulfillment on premises, macro off premises. It's all of these modalities. The real secret is the only one where retailers make money is when you come to the store and actually pick it up yourself. Yeah. If you take the cost of fuel today and labor today, the return rates for delivered items today, which far exceed, depending on which category, in-store purchases, it's really a market share game for retailers to try to grab. But even Amazon is trying to get you to the store now. They're offering a $5 coupon at Kohl's if you return. They're trying to get calibrate Amazon Fresh in the right sense. But they all lose money online. And so today, again, with rising labor costs, with rising fuel costs, with inflationary pressures across the board they're all now trying to get that omni-channel permutation correct. And so it's profitable at the end of the day, not just a market share game. And so our focus today is on brick and mortar omni-channel critical. Like you said, it's curb to curb. The advantage of a freestanding building, if you think about a shopping center, if you're in the middle of a shopping center as a tenant today, your front door is for consumers to come in and out, right? The glass sliding doors, vestibule. The back door, or on the back of the shopping center, is trash and deliveries with a truck dock. So you only have two walls. You can't have a drive-through window. You can't have a pickup window. People have to generally walk across a parking lot. So it's not convenient. So what we see today is having that curb-to-curb control and being freestanding is much more amenable to retailers who are destinations unto themselves. Very few people just stroll around the mall or stroll around shopping centers anymore. They get in, they get out, just because of the convenience aspect. But also they control the whole premises. They can add pickup lanes. They can have drive-through windows. They can restripe the parking lot. They can add click and collect lanes like they all did during COVID. And so COVID accelerated all of that. Now the permutation that all retailers are trying to find is what is the right in-store versus delivery and everything else.
That's terrific color. Thank you so much for that. I'm going to ask a little bit more about that later when you also have really good insights into grocery and how things are playing out with dollar stores and the fact that $1 to $5 items are not very deliverable. So I'll ask you about that in a little bit, but thank you so much for that really interesting color.
They're deliverable if you want to lose money.
If you want to lose money, it's a good business. Make it up in volume. All right. So these are relatively smaller properties in the neighborhood of a few $1 million each. I think it's about $3 million each. I did the quick math. On average, rather than sprawling properties that might restrict your ability to diversify geographically. So like you said, smaller properties, and you have a lot of them, so you can be everywhere because you're not servicing them. In addition, the triple net leases means you don't have to service them. You can be spread out without losing efficiency. Can you speak quickly to your geographic diversification?
Yeah, we're in all 48 continental United States, and last quarter added Alaska. And so someone actually told me Alaska is a continental United States. They clarified for me. So we added Alaska with an O'Reilly Auto Parts in Alaska. We are across the country looking for the best opportunities, whether it's primary or tertiary markets. There's a lot of emphasis placed on in the headlines and TV and in the Wall Street Journal and New York Times on New York and San Francisco and Boston and LA. That's not where the majority of shoppers are in this country, right? That gets the attention, but doesn't really get the true nature of retail investing. And so today we're highly diversified across 49 states and looking at opportunities and frankly closing on opportunities across all of them every day.
Are you going to go to Hawaii?
Yeah, we've looked at some things in Hawaii. It's pretty far from Detroit, where we're sitting today. So it's pretty far. I won't rule it out. And my thoughts are with the Hawaiian people.
Yeah, with the fires.
First people. I was actually in Maui for the first time on spring break with my family in March. So actually, right there.
Wow.
So it's distressing to watch, but I wouldn't rule it out. There's some nuances to owning real estate in Hawaii. Lots of it's on leaseholds. We'll see.
Interesting. Thank you. And then I want to talk about your performance has been excellent. We've talked about your growth. You went from 72 to more than 2,000 properties and very profitably. And one more thing before is that your sector, retail, is like you talked about. There's a lot of companies going out of business. Your biggest clients, Kmart, Borders, they all went out of business. And so things like healthcare and residential, maybe they're safer. So they have lower cap rates. So you enjoy higher cap rates in retail. It's you and hotels basically are the only ones that have pretty good, and meaning that you get high rents, relatively speaking. Yeah. And then and your performance has been excellent. With that growth, you have paid out the vast majority of your free cash flow in the form of generous monthly dividends rather than reinvesting because you have to for tax purposes. Yet incredibly, you have more than doubled your free cash flow per share over the last decade. Can you talk about your terrific track record and how you've been able to grow the free cash flow so well without reinvesting?
More than double. I think it's 10 times.
Free cash flow per share?
Oh, free cash flow total after the dividend. I'm talking about that the company retains.
Yeah. With that's what I'm
Yeah.
saying is that even after
Yeah.
just giving the
Yeah.
cash away, you've still
Yeah.
more than doubled. Yeah. So the total return is
Yeah.
incredible. Yeah.
Yeah. One of the most interesting facts when I look back upon the history of the trajectory of the company, and I often forget to separate the pre-COVID and post-COVID, just because we hockey sticked, especially during COVID, is when I effectively took over the company, free cash flow per share to the company after dividends was approximately $1 million. This year it'll be somewhere between, call it 80 and $90 million. Lever that at 25% on the balance sheet, right? And you basically have your cheapest form of capital in terms of free cash flow. Well, obviously inhibited by driven really by our dividend policy plus
Mm-hmm.
the REIT policy, as you mentioned. But it's a material source of capital for us to reinvest today. Now, dividend policy and net lease REITs, we have investors that live off, obviously, as you mentioned, it's a monthly dividend. We have investors that live off of it. We have rededicated large institutional funds that want us to retain that free cash flow. So what we've done is try to have predictability and transparency into that dividend policy. We shifted it to a monthly dividend, which I love. I love getting. I think it's coming Monday. And at the same time, we want to grow that dividend for investors. But it's a balance always. Reinvesting that capital or paying it out in the form of dividends. I love getting it monthly. Obviously, it's not a surprise, but it's a great thing to see hit your account.
It really is. So just real testament to how well you've done. Just great work. And then I want to get back to you talked about delivery and the changing landscape of retail. Specifically, I want to talk about grocery and drug. Can you give us some commentary on the changing landscape of grocery and drug sales? You've got your finger on the pulse of grocery, dollar store, big box store, and drug stores. What does the landscape look like to you now and in the future?
So let's start with grocery. We recently put out a white paper on grocery.
Right.
I'd encourage everybody to read that. Historically, grocery in this country has been a 2% margin business. It's the most difficult business to run from a retail perspective outside of restaurants. We know what the restaurant failure rate is, right? One out of three make it 4 years, I think it is.
Wow.
Grocery is a 2% margin business. No grocer ever made money in the middle of the store. Boxed canned goods, paper towel, toilet paper, those are all loss leaders. Wow. The end caps and the perimeter of the store, inclusive of prepared foods, produce, butcher, is where grocers make money. Okay. So let's just take the average $100, let's just call it $100 basket at a grocery store. Okay. How long do you think it takes a worker at a Kroger or an Albertsons or anywhere to manually pick, if you go online, $100 basket? Now they know the store, but they got to walk around and grab them off the shelves, put them in the cart, and bag it. How long do you think that takes?
Well, I should know this because I get $100 or $2 orders all the time from grocery stores. I'll say like 10 minutes.
Okay, so let's say it takes them 10, 15 minutes to right. Let's choose 15. It's easy.
15. Okay. Yeah.
1/4 of an hour. Okay.
Yep.
What do you think the average loaded wage today is for the Kroger employee? The union shop. What do you think the average wage is, fully loaded to the company, fully expensed,
including healthcare and everything?
Everything fully loaded.
More than 20 an hour.
Okay, so 20. We have, you said 15 minutes for that $100 basket. The net margin generally on the $100 basket for an in-store shopper is $2. All right, so you said $20. You said fully loaded.
Yeah.
All right, so divided by 4, 15 minutes, 1/4 of an hour.
$5.
That's $5. $2 minus $5 is what?
Minus
-$3.
Yeah.
It's -$3.
Yeah.
So grocery has historically been, outside of this highly inflationary period that hopefully we're coming out of, where everyone was running to the grocery store, having them delivered for food because restaurants were closed.
Yeah.
Has been a very, very, it's a logistics business at its core.
Yeah.
Especially for large grocers. So the model we just talked about, we did the math on, that you and I did the calculus on, does it work? And so what you see today is a full-blown war. And grocery will turn into a war in this country because of the low margins and the dollars that it takes to invest in three things specifically, unless you're a very niche grocer. Trader Joe's, right?
Right.
Wegmans, HEB with a cult-like following, Market Basket in New England. It's coming down to investing in the fulfillment. That's why you see we have a white paper on this too. Kroger, Ocado, macro fulfillment. Walmart, micro fulfillment, trying to eliminate the labor costs using investing in automation, fulfillment technology. Two, labor. You have to have employees that care about the store.
Yeah.
The best retailers in the world, their employees, Tractor Supply says this all their time. Their team members are their customers. It's the same when you go to Costco or Chick-fil-A or Apple. Their team members are their customers. They're ubiquitous. They're one and the same. And three is price. Everybody knows in 2 seconds how much something costs right here. And so if you can't invest in price, in fulfillment technology, and in labor today, you've got a big problem. And so what you see from our grocery strategy is we're wholly focused on the biggest grocers in this country that have the balance sheets and the capital to experiment and try to figure out what the future of actually productive grocery looks like. And so the merger you referenced, Kroger, Albertsons, that's just to compete with Walmart. Don't forget, Walmart and Kroger now own their own dairies. They're pumping their own milk to drive margin. Wow. They're pushing all of their proprietary products. It's a price war at the end of the day.
Yeah.
And as soon as Walmart wants to flip the switch to price war, because one other point, and then I'll shut up. The three largest grocers in this country don't make money on grocery. Walmart, they make money on the hard and soft goods. Grocery is the leader.
Okay. Yeah.
Costco makes money on memberships, not grocery.
Okay.
Amazon makes money on data and advertising, AWS and advertising.
Right.
And so if you're just a traditional grocer today,
you're in trouble.
and you want to compete against these Goliaths who don't even need to make money in the space, and you're in a 2% space, you're in real trouble.
Yeah.
And so that's the grocery space.
Well, and then where you went with that was that the dollar stores are becoming the new in between trip to the Walmarts.
100%. That's their whole business model, right? They're going to be 20 minutes from the nearest Walmart. They're the fill-in trips. You go to Walmart every 7 to 10 days for the full shop, and then the dollar stores are the fill-in trips. You also have Aldi, which is an amazing operation, penetrating this country. You have all of these different competitors nibbling at the edges too. And so it's grocery, I fully anticipate, although a lot of real estate investors think grocery anchored shopping centers are the most safety, right? The most safe investments. I think C- and B- grocers in this country are in a whole world of hurt coming up because they don't have the capital to invest in those three things.
Wow. And you've been so generous with your time. I hate to keep asking, but you've got such good insights on the drug stores. I know you think that CVS is crushing Walgreens. You guys got away from Walgreens a little bit. Can you talk about that?
They're my biggest tenant.
Yeah.
I developed 30 of them myself. They're our biggest tenant. And so I've been front row watching what's happened. And what's happened with the pharmacies is the $350,000 to $400,000 per rent per year, $25 to $30 per square foot on the 13,000 to 14,000 square foot box worked historically in this country when you went there to get toothpaste, deodorant, snacks, and all those other high margin items. So 2/3 of the EBITDA from a pharmacy comes from what they call the front end, those types of items. 2/3 of the revenue comes from the back end, the pharmacy, right? The actual dispensing pharmaceuticals. Well, today, I don't know about you, Joey, but when I need toothpaste, I click on Amazon and I click buy again, and it shows up the next day. I don't need to go to the store. Right. The only thing, I'll be honest, the only time I actually go to the pharmacy besides to pick a prescription today is on Mother's Day and Valentine's Day and our anniversary. And it's generally the day of. And those cards are like $9 now. I was like, this is crazy. This is nuts.
That's a margin business. Yeah,
that's a margin business. And so the front end sales of these pharmacies, the calibration of the EBITDA drivers are totally off now. So the fixed cost structure of the actual store, their largest fixed cost is their rent, doesn't make sense with the EBITDA and the sales from the front end.
Wow.
You also have pressure on generics, and everyone thought Amazon was going to take over pharmacy, and that never happened. But there is pressure on generics as well.
Okay.
And so CVS was forward leaning. CVS went out and bought a PBM. They bought Aetna. They installed the Minute Clinics, the health hubs. They became a fully integrated healthcare provider. They eliminated cigarette sales. A fully integrated healthcare provider. All the while, Walgreens was trying to buy Rite Aid, add more stores, more fixed cost structure.
Right.
And so very quickly we realized that it didn't make sense anymore. Just walk into the store.
Yeah.
It didn't make sense. There's nobody buying all the potato chips and the cosmetics and the deodorant and the toothpaste and the toothbrush in there anymore. The C stores took the potato chips and everything else, the large format C stores,
Yeah.
and Amazon and the big box guys took the other stuff.
And I guess the CVS I go to is in a Target now.
They bought all the CVS's out. Yes.
Yeah.
Target sold their in-store pharmacies to CVS.
Yeah. Yeah. Wow. So just like in grocery, they don't make any money. You got to find a way to make money around it. Then CVS found a way to make money around the area, getting to healthcare around the drug sales area, the healthcare data.
Right.
Yeah. Wow. Very, very. Thanks so much. Very interesting. Your growth has been outstanding, and now your growth's been outstanding, but now you see astonishing opportunities for further acquisitions. On the latest call, you said, quote, "We've never seen the diverse set of opportunities that we've seen. The lack of competition in the market is frankly stunning. It's us and sellers' expectations. And so the private 1031 buyer has vanished except the infrequent ones." 1031 is a tax thing where you can switch properties without paying a capital gains tax, right? Yep. So the 1031 buyer has vanished except the infrequent ones. The high net worth individuals, you don't hear about them overly too much. The non-traded REITs, of course, aren't playing in the space anymore. And then the levered private purchasers can't get the leverage. So we really have our choice here, and it's an interesting paradigm to be in. And as I mentioned in the prepared remarks, I've never seen an opportunity so ripe and fruitful with that wide-ranging spectrum of opportunities. Holy moly. Can you speak to the growth prospects and your plans?
The biggest surprise of my career is I never thought we'd be an $8+ billion enterprise and our competition would all be gone. It's the biggest surprise of my career. Our publicly traded listed peers have all gone in divergent investment strategies and directions. The non-traded REITs, the levered purchasers, the 1031 buyers, they're all gone. And so we're sitting here looking at all this broad pool of assets. We're the first and last call, and what has to make sense at the end of the day is price. Right? It has to make sense given our cost of capital. At the end of the day, net lease investing is a spread investment game. Now, give us the stock price, give us the $70 stock price again, we can double this company in 3 years. But again, we're not going to sacrifice quality. That is something we never will. Right? This is the best retail portfolio in the country. It started as a distressed way, as we talked about in 2010. I'm not going backwards in terms of sacrificing quality.
Good.
We're Walmart's largest retail landlord. They're our largest tenant, our best relationship. But at the same time, there has to be an appropriate spread. And so, as I said, when you read it back, it's sellers' expectations of pricing. And so every single day, another seller, another owner, another developer, whoever it is, institutional, private, we call them, they wave the flag. We have a wall of capitulation in the office.
Unbelievable.
Every time a seller capitulates, we post the deal on the wall. Yeah, it's a little white flag. We post it on the wall. But at the end of the day, the hope that pricing is going to go back to 2021 and the first 2/3 of 2022 levels, that ain't happening.
Yeah.
That Bitcoin was at 60,000 too back then, and people were buying NFTs left and right.
Yeah.
So I'm not sure what those are.
Low interest
And SPACs and everything else. So yeah, it's an amazing opportunity set. We have to be disciplined in how we execute it. We're not going to grow our denominator for just growth's sake. We're going to drive per share value to grow per share AFFO to grow per share dividends, and maintain a fortress-like balance sheet.
Awesome. And you just mentioned the balance sheet. So along with that, all those growth opportunities, your balance sheet is in great shape as well, from both the perspective of total indebtedness as well as maturity schedule. Your lease maturity schedule also looks good. Can you tell us about your balance sheet, both from a perspective of acquisitions, but also managing risk?
This has been the most conservative balance sheet, if not all the entire REIT sector, the net lease sector, for years, since before My father taught me a couple things when I was young. Number one, he believed that any debt with a balloon, which wasn't self-amortizing or self-liquidating, he called a bullet loan, not a balloon, a bullet. And two, he doesn't believe in home mortgages once you could afford them, because you never want to sacrifice your family and your home. That's what I was taught as a child.
You know, a lot of
So,
people might not know that a lot of the offices are these balloon bullet payments you're talking about.
oh yeah,
That a lot of people might not know that these are coming due so
yeah,
horribly, and you guys avoided all of
correct.
that. Yeah.
Now, whether he's right or wrong, those conservative principles of leverage, personal leverage, and corporate leverage, and the use of leverage were instilled into my brain as a young child. This balance sheet is a fortress balance sheet. It's Baa1, triple B balance sheet. It's investment grade, frankly underrated, most likely. We have access, obviously, to the unsecured markets. We just did a 5.5 year term loan unsecured, which I'm not sure how many other REITs in the country could do that in today's environment at 4.5 fixed for 5.5 years. We've obviously accessed the preferred market. We issued the lowest preferred coupon in the history of REITs outside of
Wow.
public storage at 4.25 a few years
Wow.
ago, a
Whoa.
couple years ago.
Wow.
We invented forward equity in the space. We're the first ones to use forward equity, both off of regulatory transactions and off of ATMs. Now all of our peers are using it.
Wow.
So we've been at the forefront of balance sheet management. The balance sheet is never getting in the way here. Joey, I have too much skin in the game. I have too many principles that were driven into my head about conservative balance sheet management. And frankly, I've seen REITs in Michigan get destroyed down the street from me from leverage during the GFC. I saw it happen firsthand.
That's all the
And
more
it's never happening here.
The growth that you have against the conservative way you've run your balance sheet is all the more incredible. It's just really incredible. People got
leverage catches up with everybody at some time.
Yeah, I agree. You and Warren Buffett agree on that.
Yeah, we do.
And then you just mentioned that you're a shareholder yourself. And when I mentioned that the free cash flow per share more than doubled, you're like, hey, now we got like 10x on the total return. You would know as a shareholder, your stock price is plainly too low. Your record is terrific. Your future is bright, and your valuation is a gift for shareholders that want to buy. Company insiders seem to agree. No one has sold since the COVID scare, and there's a lot of buying, including multiple $1 million buys, multiple $1 million or more buys, and multiple significant buys from the Agree family, you and the Agree family. When do you think the stock will get the re-rating it deserves? You mentioned 70 a share. I mean,
listen, my family has never sold a share of stock of this company, and in the last 2 weeks, I bought $2.5 million more, and most of my compensation comes in equity that vests and is measured over a 3-year period and then vests over a 3-year period. We're in this for the long haul. My skin's in the game. My family's skin is in the game, and we're not going there. When your name is on the door, you run a business very differently, and we fully believe in the future of the company. When the stock re-rates, this market, Joey, nobody can give you answers for why anything is priced as it is, right? We're in a period of volatility and uncertainty. It's unprecedented times coming off of $5 trillion in stimulus, interest rates at 0%. We haven't had a recession in 15 years, which is double the average duration. We're in a period where, and I can't figure it out. So I call all the people I respect on the street, whether they're buy side, sell side analysts. No one can give me an answer either, frankly. Is it the computers that take over, right? Is it the algorithms? Is it profit taking? Is it repositioning? Is it long, short? All things that are over my head. All I know is we can run a business the right way. We keep our head down. We do the right thing. And eventually the market is going to correctly value this company. That's all we can do.
Now, you guys, it just occurring to me, first of all, we talk about on the show all the time, founders. Founders do have, are a sustainable competitive advantage. You are running your company better than anybody else, but you can't be hired away because it's your family's company. And you, Elon Musk, Jeff Bezos, you are a sustainable competitive advantage. We talk about that all the time. In addition to that, we also talk about serial acquirers. I don't know why it's only occurring to me now, but companies like Warren Buffett's Berkshire, that they're a serial acquirer. Acquisitions are tough, so those companies don't get great valuations. But when you get acquisitions right, these companies, they went 250x. We look at others that have gone 250x. You guys are a serial acquirer, and some of the best serial acquirers are from families. They know how to, they give a really good formula. They stick together, have a really good formula for acquisitions and do it. Anyway, are you familiar with the concept of serial acquirers? You guys consider yourself that? Yeah.
Yeah, by definition, a net lease
Yeah.
REIT is a serial
Yeah.
acquirer. I mean, the majority of growth, net lease REITs, the vast bulk of their growth comes from external acquisitions.
Yeah.
Recycling of internal capital through the free cash flow after dividend plus dispositions, raising external capital in the form of debt, equity generally, or the preferred I mentioned, and then deploying that capital on an accretive basis. So are we a serial acquirer? Yeah, we'll probably acquire 400 properties again this year, develop another 30.
Yeah.
This is a transaction-oriented company. Every deal at the end of the day I approve in investment committee, which we have this afternoon. But I do believe that there is a different mentality with acquisition-oriented companies and founders. I never looked at the numbers outside or frankly the qualitative outside. But I'll tell you one thing: when your name's on the door, you're not a hired gun. Now look, if someone wants to pay me the Shohei Ohtani money as a free agent, maybe I'll look at the job. But when your name's on the door, your reputation and integrity is on the line, your family's, skin is in the game like mine is, you have a different risk return profile.
Yeah.
But I believe in this space, we're not a tech company.
No.
In this space, which people are relying upon, are stable and consistent dividends and earnings growth, right?
Mm-hmm.
They're not looking for volatility. I think that aligns with this space.
Yeah.
Right? We're not inventing anything new here.
No.
We're just making things better all the time. Every day.
You invented a forward earning equity and regulatory.
Yeah, it didn't get the patent.
You've been so generous with your time. Let me ask two more if I can.
Sure.
Realty Income is a triple net lease REIT that is very popular. Many more people are familiar with it. It seems your performance been a little better, your growth been a little bit better, your balance sheet a little bit better. Your founders, you're a good company. They are a good company in stock, but yours seems to be a bit better value. I do like them as well, but it just seems to me people know that one, but they should know yours. It seems to just be a little bit better on every measure. Can you give Realty Income investors a pitch to switch over to some ADC?
Well, first, there are a lot of good companies in different spaces. This isn't a football game. There isn't one winner or one loser at the end of the day. I had the opportunity when I launched our acquisition platform. It was young back in the day in this business. There were two companies predominantly in the space: Realty Income and National Retail Properties, ticker symbol AAA.
Yep.
I had the opportunity as a 20-year-old in my 20s to watch both of them and take the pieces and parts from both of them that I thought would best formulate a net new blue chip REIT. Now, Realty Income, look, it's a great company. It's a very large company. They have to invest billions of dollars a year globally, casinos, different sectors. We are laser focused on our 30 to 35 sandbox retailers in the United States today, absent Hawaii, but in the United States today, the biggest and best retailers in the country. I'm not focused on Europe. We don't do anything in Europe. Our head of IT is there on a trip with his family right now. That's about as close as we get. We're focused on this. We're not buying casinos. We're not buying industrial. We are retail specialists. But I tell people, investors, all the time, back to Warren Buffett and Charlie Munger, diversification or worsification. Charlie Munger calls it worsification.
Right.
Our core competency here at Agree Realty, my personal core competency, and the team I built, and all companies are ran by teams of people, is retail real estate. That's our expertise. It's not industrial. It's not casinos. It's not Europe. It's not Italy. It's not Ireland. It's not Great Britain. We stay in our core company. And I tell people all the time, if you want industrial exposure, go find the best industrial management team out there. Maybe it's Prologis. You pick your horses, who you think are the best operators, invest in them. That's not what I'm good at, right? Frankly, I don't know anything about industrial real estate, to be honest. I don't know much. If you want European exposure, find the best European management team out there. If you want casino exposure, find the best casino. I believe diversification and worsification can often get mixed up. We're 100% focused on what our hedgehog is, and that is it's the hedgehog concept from Jim Collins.
Good for you. Yeah, that's you. Just like Warren Buffett. Yeah, you know your core areas and stay there. That's terrific. And
If you look at Berkshire, the bulk of their holdings are in 10 companies.
yeah. And I think 4 total areas. I think.
Right.
Yep.
That's right.
Yep. And then so to wrap up here, your performance versus the field, your total returns over the last 3, 5, and 10 years. Sorry, I have a quote here. I didn't use it. I turned into a question. This is a time you were talking about your performance. Sorry, that's a quote that I didn't turn into a question. That's actually everything. Joey, you've been so generous with your time, and this has been so helpful. You're so insightful. Thanks so much for everything. And people must know about your company. I didn't realize how foundational you and your company were to the space. And how, frankly, that this is. I thought your company was the best REIT before talking to you. I think you're even better.
I appreciate it. It's again, I would encourage everybody to go to the website. Those white papers, the things we've produced, the content on there, we've under marketed and honestly, we can do better there. But there's some really insightful things to understand the genesis and the baseline of this business, retailers and real estate. We have over 2,000 properties, but there's a reason we buy every single one. And a lot of that gives the vision and perspective there.
Awesome. Thank you so much, Joey, for your time.
Thanks,
Congratulations on the new office there.
Thank you. Appreciate it.
I just want to point out that we have. I'm gonna now that we've done the interview, I'm gonna market it, but I didn't market it too well beforehand. Sorry, but somebody just said, "Good morning, Joey. Very insightful. I like what I'm hearing. Thank you, Mr. Agree." So. People are liking it. We'll do a good job of marketing it over the weekend. All right. Thank you so much. Congratulations on the new building as well.
Appreciate it. Have a good weekend, Joey.
Thank you, Joey. Great talking to you.
Thanks.
All right.
You too.
That was totally awesome. I loved that company before speaking with Mr. Agree, and I thought he was great before speaking with him. How great is that company and their growth trajectory? They're a serial acquirer with founders, and they're high yield and growing like crazy, great balance sheet. And they've never been in such good position for acquisitions too. And I didn't realize they were so foundational to the space. What a great company. Founders, small company that people like us should be buying. Great to see you guys. We'll do it again next week. I'll see you in the Discords. Have a great night. See you in the Discords.